It begins with an unprecedented surge in the US stock market. Over the course of a few years, the major indices have collectively skyrocketed by 900%. This extraordinary boom sends shockwaves through the financial world, triggering exhilaration, speculation, and a mix of optimism and caution. For investors, it is a moment of unprecedented wealth creation. For corporations, it opens avenues for expansion, mergers, and acquisitions. For the US economy, the implications are vast, complex, and transformative, touching every sector, market, and household. The first immediate impact is on investor behavior. Individual investors, seeing their portfolios multiply nearly tenfold, gain immense confidence. Stock ownership becomes more widely distributed, with retail investors participating alongside institutional investors in historically large numbers. Wealth effects are pronounced. With equity holdings increasing dramatically, households feel richer, boosting consumption across goods and services. Retail, luxury, and discretionary sectors see a rapid increase in demand, and stock valuations for companies in these sectors continue to climb as consumer confidence and purchasing power surge. Corporate finance transforms. Companies realize the extraordinary opportunity presented by an overvalued, yet bullish stock market. Equity financing becomes the primary method for raising capital. Initial public offerings, secondary offerings, and private placements multiply. Firms issue shares to fund expansion, research, and acquisitions, diluting ownership but capitalizing on unprecedented market enthusiasm. Stock prices continue to benefit from a feedback loop. More equity issuance funds growth, which further drives market valuations. Mergers and acquisitions accelerate. Corporations leverage their skyrocketing stock prices to acquire competitors, consolidate markets, and expand internationally. Mega mergers in technology, healthcare, energy, and consumer sectors reshape industry landscapes. Stock markets respond positively to strategic deals, while regulators struggle to evaluate the implications of concentrated corporate power in a rapidly inflating equity environment. The banking and financial sector experiences unique effects. While banks benefit from increased corporate activity, wealth creation, and trading volumes, they also face risk management challenges. Margin lending surges as investors borrow against inflated stock values, increasing exposure to market volatility. Stock valuations for brokerage firms, investment banks, and fintech platforms rise sharply as trading volumes and asset management fees multiply. Yet systemic risk grows as leverage levels reach unprecedented highs. Consumer behavior changes dramatically. With portfolios growing exponentially, households increase spending on luxury goods, real estate, travel, and technology. Stock markets for consumer-facing sectors respond positively to these wealth-driven expenditures. However, inflationary pressure begins to appear as demand outpaces supply in critical sectors. Prices for housing, vehicles, and high-demand consumer products rise rapidly, raising concerns about affordability and social inequality. The real estate market becomes supercharged. Investors use increased stock wealth to purchase residential and commercial properties, driving home prices and commercial rents to new heights. Stock valuations for home builders, REITs, and mortgage lenders surge. Urban centers experience gentrification as wealthier individuals and institutional investors compete for limited properties. Regional disparities emerge, with high-demand areas seeing exponential growth, while rural or economically lagging regions experience slower gains. Corporate strategy evolves under a bullish market environment. Firms prioritize growth, innovation, and market dominance, leveraging equity financing to fund research and development. Startups and technology firms experience explosive growth as venture capital, private equity, and public market enthusiasm flow toward innovative sectors. Stock markets reflect optimism, with sectors like AI, biotechnology, renewable energy, and cloud computing benefiting disproportionately from investor attention and capital inflows. Global trade dynamics shift. U.S. companies, flush with capital and confidence, expand aggressively into international markets. Exports increase as corporations invest in overseas production, marketing, and infrastructure. Stock markets for multinational firms benefit from revenue growth and market expansion. Simultaneously, foreign investors are drawn to U.S. equities, increasing capital inflows, strengthening the dollar, and creating a perception of American economic dominance. The labor market experiences both opportunity and tension. Corporate expansion leads to unprecedented hiring, wage growth, and talent competition. Stock markets for professional services, staffing firms, and training providers surge. Yet, rising inequality and talent concentration create social tension as companies compete for top employees in high-demand sectors, driving wage inflation and skill gaps. Inflation becomes a critical consideration. While the wealth effect boosts spending, production capacity cannot expand at the same rate. Prices for essential goods, housing, and services rise. Stock markets begin to price in potential inflationary pressures with sectors sensitive to costs, such as consumer staples, energy, and industrials, experiencing mixed performance. The Federal Reserve faces challenges balancing a booming market with inflation containment, as traditional interest rate tools risk destabilizing market sentiment. Financial markets face systemic risks. The extraordinary boom encourages speculative behavior, with investors taking on leverage, trading derivatives, and engaging in high-risk strategies. Margin accounts grow exponentially, and hedge funds increase exposure to highly volatile sectors. Stock markets experience extreme volatility in response to geopolitical events, policy changes, or sudden shifts in investor sentiment. Systemic risk management becomes paramount. Pension funds and retirement portfolios undergo dramatic shifts. Beneficiaries see massive gains in asset values, creating an artificial sense of security and wealth. Stock markets for asset managers, financial advisors, and retirement planning firms reflect increased activity as households and institutions rebalance portfolios, taking profits and seeking diversification. However, risks of a market correction loom large due to inflated valuations and high leverage. Corporate debt dynamics are transformed. With soaring equity values, firms shift toward equity financing over debt issuance. Leveraged buyouts and corporate restructuring become more common, funded primarily by inflated stock values. Stock markets reflect optimism, but analysts warn that dependence on high valuations creates vulnerability to market corrections or policy shifts. Consumer technology adoption surges. Households use newfound wealth to purchase electronics, smart devices, and entertainment technology. Stock markets for consumer electronics, software, and digital services see record growth. Simultaneously, investors bet on high-growth technology sectors, driving valuations to extreme levels. Venture capital and private equity experience unprecedented inflows. Entrepreneurs raise massive amounts of funding, fueling startup growth and innovation. Stock markets respond positively to companies transitioning from private to public markets, reinforcing the cycle of wealth creation and market optimism. Corporate governance evolves under the boom. Shareholders exert influence on executive compensation, strategic decisions, and market expansion. Stock prices remain elevated as investor sentiment prioritizes growth, profitability, and market dominance. Firms invest in public relations, marketing, and branding to sustain positive perceptions and maintain valuation momentum. Consumer spending patterns reflect both optimism and caution. While discretionary spending surges, households also seek to protect gains from volatile markets. Stock markets experience intraday volatility as trading activity reflects both excitement and fear of corrections. Sectors tied to luxury goods, travel, and high-end real estate benefit disproportionately, while essential sectors demonstrate steady but slower growth. Global investors adjust portfolios aggressively. Capital flows into U.S. equities, real estate, and high-yield assets, reinforcing the market boom. Stock markets for multinational firms and export-oriented sectors reflect benefits of increased foreign investment and favorable currency effects. Conversely, global competitors face capital flight, affecting foreign equity and debt markets. Inflationary risks rise further as consumer and corporate demand outpaces production capacity. Stock markets begin to reflect concerns about interest rate hikes, supply chain bottlenecks, and wage pressures. Essential commodities, energy, and industrial inputs see price volatility, impacting corporate margins. Corporate strategy prioritizes opportunistic expansion. Firms invest in mergers, acquisitions, overseas operations, and R&D to capitalize on record valuations. Stock markets reward firms executing growth strategies effectively, while companies failing to leverage the boom underperform. Labor markets tighten further. Talent competition intensifies across sectors such as technology, finance, healthcare, and engineering. Wage inflation accelerates, creating cost pressures for corporations. Stock markets for firms with human capital advantages perform well, while those struggling with recruitment face operational risk. Regulatory scrutiny intensifies. Government agencies monitor mergers, acquisitions, and market concentration. Stock markets react to regulatory announcements, with enforcement or antitrust concerns causing short-term volatility. Yet overall optimism remains, driven by robust corporate earnings and market sentiment. Housing and real estate markets reach unprecedented heights. Wealthy investors, equity-rich households, and institutional investors drive property prices upward. Stock valuations for home builders, REITs, and mortgage lenders reflect extreme optimism, while affordability concerns and social tension emerge as challenges. Global trade sees structural shifts. U.S. corporations dominate key industries, exporting technology, goods, and services aggressively. Stock markets for multinational corporations reflect growth in revenue, market share, and international influence. Meanwhile, foreign competitors adjust strategies to contend with U.S. corporate dominance. Financial markets innovate rapidly. Derivatives, structured products, and new investment vehicles proliferate as investors seek exposure to high-growth sectors and protect gains. Stock markets for financial institutions, fintech, and investment management firms benefit from increased activity and fee generation. Consumer confidence remains exceptionally high, but behavioral biases emerge. Overconfidence, speculation, and herd behavior create vulnerabilities. Stock markets experience high-frequency trading activity, short-term volatility, and extreme price swings, especially in technology, consumer discretionary, and speculative sectors. Corporate earnings projections soared. Companies leverage market enthusiasm to fund innovation, expand capacity, and enter new markets. Stock markets reward firms demonstrating robust execution, strategic foresight, and high growth potential. Yet the risk of correction or policy intervention becomes a persistent undercurrent. Pension funds and retirement portfolios experience windfalls. Beneficiaries feel secure, yet exposure to high valuations and potential correction creates hidden risk. Stock markets reflect reallocation activity as institutions hedge, diversify, and balance portfolios in a hyper-valued environment. Energy markets respond to corporate and consumer expansion. Industrial activity, transportation, and real estate demand increase energy consumption. Stock valuations for oil, gas, and renewable energy producers rise in tandem with heightened corporate and consumer activity. Global financial systems experience both admiration and concern. U.S. equity dominance attracts investment, yet market exuberance raises questions about sustainability, leverage, and systemic risk. Stock markets for internationally exposed firms reflect benefits and vulnerabilities simultaneously. Corporate debt dynamics continue to evolve. With high equity valuations, firms favor stock issuance over borrowing, reducing leverage risk but increasing dependence on market sentiment. Stock markets remain highly sensitive to investor perception, market news, and macroeconomic signals. The scenario illustrates how a 900% stock market boom would fundamentally transform the U.S. economy. From consumer behavior, corporate strategy, labor markets, and investment patterns to global financial influence, wealth distribution, and market dynamics, the effects are profound, pervasive, and enduring. Stock markets reflect extraordinary optimism, but systemic risks, inflationary pressures, and overvaluation create underlying vulnerabilities. Ultimately, such an unprecedented boom redefines corporate strategy, consumer psychology, investor behavior, and global economic positioning. While the immediate effect is wealth creation and economic expansion, long-term stability requires careful risk management, regulatory oversight, and market discipline to navigate the challenges of extreme valuations and speculative exuberance.